Welcome to this explainer. If you're a financial executive or a system architect, you already know the drill. Getting clean, balanced data at the micro level is an ongoing battle, and it's one that usually ends up delaying the entire month-end close. Today, we're going to break down exactly how SAP S4HANA handles this, giving you the power to generate complete, zero-balance financial statements for any specific entity in your business without all that traditional administrative headache.
Here's our roadmap for today. We're looking at the reporting accuracy challenge, active versus passive methods, segment balancing in action, and finally, configuration in data governance.
Section 1. The Reporting Accuracy Challenge.
So think about your current accounting operations for a second. How do you actually manage balance sheets for objects below the company code level? If you need a zero balance report for, say, a specific segment or profit center right now, consider how much manual effort that requires. Without specialized automation, creating a complete balance sheet for an object below the main company code usually involves messy manual transfer postings or just drowning in external spreadsheets. Not only does this eat up valuable hours your team could spend on actual analysis, but honestly, every manual spreadsheet entry is just begging for an audit compliance risk.
Well, this right here brilliantly illustrates the core solution. Look at the difference. While the standard entry view groups everything together exactly as it was keyed in, the general ledger view leverages document splitting to automatically generate those granular reporting characteristics. The real business value here, it's a massive efficiency gain. Your data entry clerks don't have to change how they work or learn complex new accounting rules. They just input the basic invoice, and the system handles the whole shebang invisibly behind the scenes in the general ledger view. It automatically splits those line items so you can pull a pristine balance sheet by segment or profit center literally at a moment's notice.
Moving on to Section 2, active versus passive methods. So the first method the system uses is the active split. Basically, an active split does the heavy lifting on new documents by dividing vendor and tax lines based entirely on your custom expense rules. Think of an active split like a really smart automated mail sorting machine. It looks at the distribution rules you've built and instantly routes the tax and vendor payables to the correct profit center bins. For instance, if a user books an expense across two different profit centers, the active split uses your rules to automatically distribute the associated payables across those exact same profit centers. It calculates this on the fly, which is exactly why it's also known as an online split. On the flip side, we have the passive split. Now, a passive split simply inherits the exact breakdown from the document being cleared, seamlessly reproducing those assignments. You're going to see this most often during clearing processes, like when a payment is actually made against an invoice. The system doesn't need to go look up a complex rule. It just passively looks at the history of the invoice being paid and copies those entity segments straight over to the clearing document. This means your team doesn't have to rekey or recalculate the proportional breakdown when a payment is processed weeks later. The system's memory does all the heavy lifting.
All right, Section 3, Segment Balancing in Action.
Let's make this super concrete with a real-world example. Imagine you get a massive incoming vendor invoice for cloud computing services. That total needs to be assigned to multiple accounts, resulting in a 60% hit to Segment A, let's say your European manufacturing division, and a 40% hit to Segment B, your North American sales division. When that invoice is initially processed and keyed in, an active split is what steps in to divide up the vendor and tax lines to perfectly match this 60% to 40% distribution. Now let's look at how this builds over time. When the actual cash payment happens during the clearing process, passive document splitting kicks in. Because of this feature, the system looks back at that original cloud computing invoice and passively mirrors that exact 60-40 split right in the clearing document automatically. This ensures that the cash payment relieves the payables for your manufacturing and sales divisions in the exact right proportions, and you can see it all perfectly within the general ledger view. So here is the absolute crucial point. This zero balance formation guarantees absolute segment reporting accuracy, and it does it without requiring any manual transfer postings. Think about it. If you didn't have this function, trying to do a transfer posting from segment A to segment B on the same account would just create unbalanced line items. But with zero balance formation active, the system literally creates additional clearing lines in the background to ensure that every single object, right down to the specific profit center, balances perfectly to zero. For a financial executive, this is the absolute magic bullet. You get pristine, audit-ready precision at the micro level without adding a single step to your team's daily workload.
And finally, Section 4, Configuration and Data Governance.
Okay, so how do we actually set the rules for all this automation? Because, as with any automated system, the output is only as good as the foundational configuration. Document splitting is highly customizable. It's activated universally at the client level, but deactivated at the company code level, meaning the ultimate decision to utilize splitting is made company code by company code. To get started, your IT teams will typically start with SAP's standard out-of-the-box template, which is known as procedure 0000000012, and they'll copy it to build customized rules. This ensures that data governance is strictly controlled, mapping out exactly how every single item category should be handled across all of your business transactions. During setup, the system maintains consistent data assignment through two main concepts: inheritance and default account assignment. Now, inheritance is the ideal scenario. It's the system's way of working intelligently to minimize missing data. If an account assignment object is unique, the system automatically inherits it online and fills in any missing positions. Default account assignment, on the other hand, acts as a safety net. If no value is derived for a splitting characteristic, the system injects a constant default value, like a generic profit center, just to make sure the document successfully posts. But listen, there is a strict advisory straight from the source material regarding this setup. Relying heavily on default values can actually mask really poor data entry. Think about it. If a default constant quietly replaces every missing object automatically, your document splitting rules might actually be completely flawed, but you wouldn't even notice because the default value is covering it up. That's exactly why you should always test configurations without default values first. It is the best way to ensure true data integrity and locate any underlying errors in your item category rules. As we wrap up this explainer, I want you to evaluate your own setup. Are your default account assignments acting as a band-aid for poor data entry? Or are your active and passive splitting rules finely tuned to drive pristine, granular executive reporting? Mastering document splitting isn't just some back-end IT exercise, it is absolutely the key to unlocking true automated zero-balance reporting. Thanks for joining me today to explore this crucial piece of the financial puzzle.